So I've owned individual stocks for nearly 20 years, and I just made the switch to an ETF portfolio. I gotta say, it's feeling pretty darn good so far, but we got a lot to talk about in this video, so let's dive in. Up on the screen is my exact Wealthsimple account. This is my RRSP, by the way, the Registered Retirement Savings Plan. I am actually currently in the process of transferring my TFSA, my tax-free savings account, from Questrade to Wealthsimple. As you can see, it currently has two holdings, okay? The two funds that I have selected are VOO, the Vanguard S&P 500 Index ETF. This is a US listed ETF. We're gonna talk about that in a second. This makes up about 2/3 of the account currently. The second fund is ZEQT, the BMO All-Equity ETF. This is a Canadian listed product. This fills up essentially the rest of the account. And as you can see, I do have a good chunk of cash that I have yet to deploy. I will be deploying in the weeks and coming months. I actually just made a purchase this morning of these two funds, just slowly integrating that into the account. Of course, you can follow everything I'm doing on Blossom. It's completely free. There should be a link in bio or search in the App Store. But I want to talk about these two funds and why I personally selected these. Okay, now keep in mind, do your own research, do your own due diligence. This is just what I picked for my own personal situation. But starting off with VOO, the Vanguard S&P 500 fund, this is the classic S&P 500 fund. We see an expense ratio of 0.03%, pretty much as cheap as you're gonna get out there. This fund, of course, provides me exposure to the 500 largest companies in America. We know this. Apple, Microsoft, Nvidia, Amazon, Meta, Google, the list goes on. Of course, this is a fund that is entirely weighted and exposed to the US market. Now, ZEQT, fund number 2, the BMO All-Equity ETF, this is what is known as an all-in-one ETF. I just talked about this recently, MER 0.20%. The idea behind an all-in-one fund or ETF like this is that it has a predetermined asset allocation or a predetermined asset mix already essentially set for you. So although this is one fund, that's what you're buying, ticker ZEQT, if we break it down, this fund holds 7 other funds or other holdings. We see a 45% split to the S&P 500 fund, our American exposure, 25% weighting to the TSX, aka the Canadian broader market, 20% exposed to the international markets, 7.5% exposed to the emerging markets, these up and coming markets. And we do even see a small amount of the portfolio in small and mid cap funds. With this one fund, understand that I am inherently invested in thousands of different companies or stocks. Importantly, I'm invested amongst the global markets. So not just the US, but I have exposure to Canada, Europe, and other international markets across the globe. A quick point to mention / be aware about is that these two funds do have overlap, and I am totally okay with it. It's just something that we have to be aware about. If we think about VOO being our exposure to the S&P 500, well, we're also getting more exposure with that through ZEQT. I am aiming for that. I am okay with that, and I'm aiming to have the core of my portfolio exposed to the S&P or the US market. That overlap does not bother me. And the way I like to think of it is these little additional exposures to the Canadian market or international markets. Those are right at the amount that I kind of want it to be. You guys know I'm not overly bullish on having too much money in the Canadian market despite being Canadian. So given that this represents roughly 1/3 of my portfolio, and then within that, we have 1/4 essentially allocated to the Canadian market, that is totally fine with me. Again, just something to be aware about. Now, a question you may be wondering, why did I choose ticker VOO over ticker VFV? Because for those familiar, these are the exact same thing. They both own the S&P 500. They're both investing in the 500 largest companies in America, but VOO trades in US dollars. It's US listed versus VFV trades in Canadian dollars. It's a Canadian listed product. Here's why. Reason number 1 is pretty simple. When I transferred my account from TD Direct Investing into Wealthsimple, I had a bunch of US dollars in the account. But secondly, arguably more important, a consideration for me was withholding tax. We've talked about this many times on the channel. Particularly, guys, by the way, I'm speaking here to the RRSP, the Registered Retirement Savings Plan, which is the account we're talking about today. For those that don't know, there is a treaty in place between the US and Canada that states that the RRSP is deemed or considered a retirement account. And depending on what types of ETFs you buy within this account, whether it's Canadian listed or US listed, they are treated differently from a tax perspective. I'm not sure how well you'll be able to see this on the screen, but what this document details is that Canadian listed mutual funds, MF, that's mutual funds, or ETFs that hold US stocks. So what we're referring to here is, for example, VFV. Ticker VFV is a Canadian listed ETF that holds US stocks. It literally holds, the S&P 500. Withholding tax applies. WHT applies, meaning it is subject to withholding tax, whereas US listed mutual funds or ETFs that hold US stocks, aka VOO, withholding tax is exempt. I've actually done a video on this a few years back if you want to search it up on the channel to learn more and dive deeper into it. But long story short, by owning the US listed version, if you will, VOO, we are exempt from paying that 15% withholding tax. To be clear, just on the dividends, okay? This is not 15% tax on capital gains. I'm not paying 50% tax on the portfolio. It's just, at the end of the day, the dividends, which is a smaller amount, especially on a fund like this, an S&P 500 fund, which isn't necessarily known for spewing out big dividends. A little bit of the dividends would be withheld had I picked VFV. This is a slight optimization that essentially I aimed for by picking VOO. Again, matching that up with the fact that I had a bunch of US dollars. To me, it was just a slight optimization, if you will. And to be completely honest with you guys, it's something I don't really care about personally. Again, you make your own decisions. And especially if you're dealing with big dollar figures like $1 million portfolios, sure, these things tend to matter a little bit more. If you're a dividend specific investor, they matter even more. But for me, it's just not a huge consideration. That's just how it happened to play out. A question that I got in that same vein was, why don't I just take 100% of the RSP and invest in these US listed products? Because I own a third of it essentially in a Canadian product, in ZEQT. The simple answer for you guys is it's not a huge deal for me. It's marginal at the end of the day. To each their own. I don't want to tell you what to do or what not to do. I'm just sharing with you guys what I'm doing. And in fact, I think this might actually transition into the next segment of this video, which hopefully will explain better my whole thought process behind the switch, because this is a huge switch of the portfolio that is essentially uprooting my entire portfolio. Let's talk about that now. Actually, a couple months ago, I did a video with Mark, which might be a fascinating one to look back on, because that's where the seeds had been planted and we had discussed in more detail all the considerations about making the switch. But really what it boils down to for me, number one, the most glaring thing that spurred this decision for me was just optimizing my portfolio for simplicity, efficiency, and in many respects, automation to help me save on time. At this particular phase in my life, as I'm getting older and growing up, that's what I deem is important for me right now. And that's very different to how things were just a few years ago. I think just 3-4 years ago, when my career was working with Mark, my father, for those that don't know, we were working at his investment firm. Prior to him selling that, my career was in finance and I was a licensed advisor, and all day long, what I did from 9 to 5, essentially my 9 to 5 was researching stocks, doing due diligence, keeping up with earnings reports. I was totally engulfed with the investment industry. Now, when I think about what I'm doing for work or with Blossom, it's a completely different set of responsibilities and roles, if you will. And in fact, a lot of them, working in the startup environment actually is a lot more on the business entrepreneurial side than the market itself. Obviously, Blossom is an app for investing for the stock market, so it is tied. But the difference, the contrast between how much time I would spend a couple of years ago to where I stand today, it's very, very different. Family is another big one. And of course, a major priority for me at this point in life. It's crazy to think my daughter's already 2.5 years old. And who knows what's in store for the future. The phase that I am at in life is just very, very different and very, very contrasting, and I acknowledge that. Reason number 2 for the switch is that I can now accept guaranteed returns in the stock market. And you guys know I'm totally joking when I say that, right? Nothing in the stock market is guaranteed. It's a word that I never ever like to use. I really do mean that as a joke. But what I mean, of course, is that my returns are now guaranteed to match the index return, that of the S&P. For the most part, is what we're looking at. And if history has taught us anything, we do know that the S&P returns us somewhere in that 7 to 8% range. Some people say as high as 10%. Again, when I factored inflation, I like to think 7, 8%. Of course, with individual stocks, we've talked about this lots, you have the opportunity to outperform. So had you been in holding Nvidia or an Eli Lilly and Co., a stock that has just done super, super well, you can outperform. Of course, with just a couple of bad picks, you can underperform, and you can severely underperform over long periods of time. With this switchover, I know that I can accept that market return for the next number of years / decades. And number 3, this is possibly similar to the first point that I talked about just a couple moments ago, but it's the peace of mind that this passive investment strategy presents. Like I said, it's literally been very little time since I've made this switch over. So this is something I can report back to and give a proper update for you guys in a number of months, maybe even years. But I really do feel already that there's this weight off the shoulders, so to speak. Don't get me wrong, you guys already know how much I love looking at stocks and how much enjoyment I got out of managing my own portfolio of individual companies. But without a doubt, there is an ease or a weight lifted when that is something you don't have to worry about. And that is something that is very, again, attractive for me at this point in life. In conclusion, it's quite the bittersweet feeling that I have going on right now. And even honestly, putting this video together, it just feels bittersweet. I don't really know a better word for that. I've owned stocks, individual stocks that is, since I was 10 years old. You guys know my story with McDonald's and Coca-Cola. And to make this change in my investing career and my journey, it's a big one. But I do feel deep down that it is the right decision for me at this time, and I'm proud to share with you guys my new portfolio. I've been making YouTube videos now for 7 years. So I started this channel back in 2016, 2017, and what's really fascinating is being able to go back and look, almost like my journey has been documented, and sharing with you guys like what I've been doing in the process, sharing my learnings as I learn more about the stock market, passing that along to you guys. And it's going to be very interesting in a few years to look back at this moment, knowing that it was a pivotal change. I think in wrapping up, one of the biggest lessons or keys that you can take with yourself as a DIY investor is being able to take a really strong self-reflection of yourself. When you're managing your own portfolio, you're the one in charge. You don't have a professional looking over your shoulder. You don't have an advisor telling you what to do. It's you, and you have to sometimes take a good, long, hard look in the mirror and truthfully identifying where you are in terms of, your phase in life, or what you can or cannot commit to the stock market, your risk tolerance, what are you comfortable with or uncomfortable with, and then picking a strategy that best suits you. Hopefully, over the years, I've been able to be somewhat of a role model or a leader or example for those that are looking to get into investing. And maybe this is a scenario where things do change, times do change, and sometimes that calls for an adjustment in the portfolio. The goals don't change. The outcomes that I'm striving for have not changed. I'm a long-term investor. I'm investing for retirement. I want to grow my wealth, but the vehicle that I'm using to do that, I think is better suited for this point in my life. With that said, I'll wrap up the video. I would love to hear your guys' thoughts down in the comment section below. Has anyone else been in this situation before where they've felt this need to make this switch? I would love to hear from you guys down below, or share any thoughts. If you guys enjoyed the video, give it a thumbs up. Of course, follow me on Blossom. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.